My name is Michael Duke, and this is the show where I analyze stocks that are interesting, or in this case, master limited partnerships. So if that interests you, then please consider liking the video, subscribing to the channel. Today, I'm talking about Alliance Resource Partners LP, ticker ARLP, MLP, that has absolutely crushed the market over the last several years. As usual, I'm going to give an overview of the company. I'm going to take a look at the financials, discuss if they have inherent competitive advantages or a moat, take a look at the dividend, or in this case, distribution, discuss some of the risks, and finally, I'm going to give it a grade. As always, this is not financial advice, it's purely my opinion. And let's get started. So, what is ARLP? Well, as they report here in the description, they're a diversified natural resource company engaging in the production and marketing of coal to utilities and industrial users. So, primarily, the company is a coal miner. The company operates through four segments: Illinois Basin coal, Appalachia coal, oil and gas royalties, and coal royalties. Produces bituminous coal from its underground mines sold to electric power generation and the steel production customers. Company operates 7 underground mining complexes in Illinois, Indiana, Kentucky, Maryland, Pennsylvania, and West Virginia. In addition, it owns and leases oil and gas mineral interests and equity interests. It leases its coal mineral reserves and resources to its mining complexes, and leases land and operates a coal loading terminal on the Ohio River at Mount Vernon, Indiana. Okay. It's a small $3.5 billion market cap. Just to illustrate this point further, the company reports we are the second largest coal producer in the eastern US. Okay, so that gives you an idea of the relative size of the partnership. It's not super large. Certainly a large company, but isolated to one region primarily, and the second largest. With low-cost Tier 1 assets serving utility, industrial, and steelmaking customers both domestically and abroad, from our 7 underground mining complexes, produce a diverse range of thermal and metallurgical products with varying heat and sulfur contents, which enables us to satisfy the broad range of specifications required by our customers. Speaking of customers, in 2024, they shipped 33.3 million tons of coal. Approximately 80.3% of tons sold purchased by electric utilities, 7.3% were sold into international markets. Let's take a step back. Why am I covering this company? Well, I do have a position in these units. It's one of the top 5 largest in the portfolio. Now, over the last year, it's performed very well. And so I'm evaluating the bull bear case here where we're at now. Another reason is I want to discuss the thesis behind a coal miner. So obviously coal mining, very dirty. Coal being arguably, if not the most flagrant offender of fossil fuel driven climate change, right? You have coal being a very dense fuel source, very dense energy source, and as such introduces a lot of pollutants into the air when it's burned, but also very effective and very cheap compared to other forms of energy, especially. So what makes coal interesting to me is that I have this contrarian view long term of energy markets, where I believe that coal, in particular, as well as other fossil fuels to a lesser extent, that coal, the demand for coal will increase before it will tail off. I think there's a big belief like, oh, everything is a clean environmental initiative now. We got to phase coal out. Well, whether that's true or not, I believe that coal demand will continue to increase. And I believe that my thesis is supported by this chart here. This is, again, a different type of coal than what we sell here in our partnership. This is the Newcastle coal. But over the last 10 years, this is the Newcastle coal price. You see where we're at here, basically similar levels to where we're kind of flatlined in pre-COVID times. Now, obviously, supply chain inflationary crunch of COVID sent all commodities flying, including coal. It went up 400%. And then it kind of settled into this new elevated base region here before kind of reverting to the mean here. So, what do you see? Again, I don't pay for the subscription to this. Maybe that makes me a bad analyst. Maybe it doesn't. But what I see here is that over the last 10 years, coal prices are up damn near 50%, even in a local low. So now let's kind of shift to the discussion of, does this company have a comparative advantage? Well, not really, because coal is a commodity and we're mining commodities and selling them. So this company is a price taker, not a price maker, which means that its cash flows and profit margins, so on and so forth, are going to be very volatile over time. So basically, what we're betting when we're making an investment in a partnership units like ARLP is that coal prices remain strong moving forward out into the future. Now, the yield of this investment pre-tax, because it's an MLP, I'm not going to discuss what an MLP is versus a stock in this video. If that's what you're interested in doing, maybe. But I did discuss that somewhat in my video about MPLX. But at 10% yield, assuming that that's safe, and we're going to evaluate that here in a moment, assuming that that's safe, you'll get all your money back in 7 years, maybe a little more than that. You don't have to hold your investment very long. Of course, if there's no growth in that distribution, it's a flat 10-year payback at 10%. So not bad, right? Do you think that coal resources and coal demand will last longer than 10 years? If you do, then this might be a profitable investment, because after 10 years, you'll get all your money back. Now, when I first started accumulating these units, it was in 2023 when they were in the low 20s, high teens. The yield was closer to 13%. So that's where the 7-year payback was coming from in my mind. The units have significantly appreciated over the last year. Here we have the assets of the coal operation, of which this graphic here representing an operating mine, we see the 7 that are here. And we have these export terminals here. So anything that is domestic, right, gets sold on a contractual basis to a utility. The rest basically gets sold on the spot market internationally. One thing I do want to point out is that the U.S. Energy Information Administration reports spot prices of the different types of coal. And you actually see here that Central Appalachian coal and Illinois Basin coal are significantly different in terms of their pricing. And that's because Central Appalachian coal is much more dense and is a better energy source. Therefore, it's more expensive than the Illinois Basin. This, of course, is the Illinois Basin. This is the Appalachian coal. So that is a different price than the Newcastle coal seen here. Although the reason that I show you this chart is purely to illustrate the general fluctuation in the coal markets. It's not too ridiculous to assume that these prices, while we do not have the means to look at this particular price in this setting all the way back on a chart like this, it is reasonable to assume that the beta or the correlation or whatever you have it of these coal prices tracks pretty strongly with these coal prices. In other words, when these are up 10-20%, these are likely also up 10-20% to varying degrees. Let's take a look at the fact sheet. It's when you invest in something like this, what you're investing in, it's more like a mineral royalty type investment, you as the LP holder, where you're attaching your cash flow to commodity prices that fluctuate. And we'll see that more clearly here in a second. I think that's what I wanted. This right here. Okay. So this is the most recent investor presentation. And I'm going to spend a significant amount of time going through this information. Okay. So again, we know that we have a couple different segments. The first of which is coal operations. Then we have oil and gas royalties, and then we have coal royalties. Okay. So you see here the segment adjusted EBITDA of oil and gas royalties is shown this green number here. Okay. So you notice again, what do we know about this period here? Well, we know that coal prices topped in this period. We also know that oil prices, I mean, crude oil was like $110 a barrel at one point. So obviously, the portfolio of oil and gas royalties was generating more cash flow prior here. So this here is the royalties segment adjusted EBITDA percentage of total. The reason that they break down their numbers like that is because management is trying to paint a picture for the unit holders or potential unit holders that they are diversifying their business away from just coal into oil and gas, which is seen as something that has more duration to it. Another thing that they're doing that I really don't want to glorify this element of the business, but one thing that they are doing is they are taking excess natural gas that's coming about as a process of their mining operations and what have you. They're taking that and they are mining Bitcoin with it and then holding the Bitcoin on their balance sheet. And we'll see that in the financials here in a moment. A little bit more granular as we see the transfer terminal here on the river. And then we see that there are 3 export terminals. One thing I want to highlight here is this. So we see that the Illinois basin represents 3/4 of our tons sold in terms of coal. However, the heat content of the Appalachian coal is much higher. Okay. So here's management kind of giving a little bit more weight to the thesis where they're saying, hey, structurally, energy demand is about to go up and be way beyond equilibrium. I fully attach myself to that narrative and believe that it is not only legitimate, but is happening today. As electricity demand is outpacing our ability at minimum to ramp up renewable energy. So that is a structural imbalance that will lead to increased and elevated coal pricing over time. And then here is an overview of some of the mineral interests. We have the Midland and Delaware basis. Each of these is a well, right? But Midland and Delaware, that's in the Permian. Anadarko is in Oklahoma, I believe, and Williston is in South Dakota or North Dakota, one of the Dakotas. So we see here there's 70,000 net royalty acres, of which 43% is oil, 31% is gas, and 25% is NGL or natural gas. And then we have the operator split: 1/4 Exxon, Double Eagle, Oventive, Occidental, Diamondback. So Devon Energy here, ConocoPhillips, lots of operators that I recognize. Here we have, yellow is your oil barrel price, but we show here the kind of the total volumes. Here, this is all you need to know when it comes to price taker versus price maker. How would we expect free cash flow to look for a price taker enterprise with no moat? I would expect it to be volatile. Again, why do we think that this might be a good investment? Because the market is very pessimistic, I think, about coal. in general, which is why it trades at such a high yield. Now, the catalyst, why has it appreciated so much? Well, I think the answer is that it just very strong cash flow relative to leverage. They paid down so much of their debt when they were able to absorb these strong, pricing increases in the market. They took advantage of that to deleverage. They also increased their payout to unit holders. And then bullishness around oil and gas, the pivoting of the business into oil and gas and into this random Bitcoin mining experiment that they have. So here, I think, is where we start to get into discussing how things are today. We see they paid out in 2024 $363 million to unit holders. Now, what do you notice here? You see how distributable cash flow versus distributions is really starting to level off and get close. So at one point in time, you had this as the status quo. There's a significant amount of coverage. Now here, what we're seeing is that the partnership is basically paying out damn near close to everything to unit holders. We see that again, 363 million is the current level of distribution. For them to continue, well, we see here coal operation generated 227 million, which was not enough to pay for the distribution. And oil and gas royalties represented roughly a third of that distribution coverage. So that oil and gas royalties are more stable than actually operating the coal mines, even though they're kind of the same idea. But I think it goes without saying that the larger we get on adjusted EBITDA here of oil and gas royalties, the more our multiple will increase. It should be worth more the more segment adjusted EBITDA we derive from oil and gas. So let's just take a look at their numbers. Again, if we just kind of zoom out here, you see what you should probably expect to see, which is inconsistent revenue, inconsistent gross profit. Their gross profit and revenue today is just about the same as it was 10 years ago, right? Not too surprising. However, because they've been able to shore up their balance sheet, you see how there's just a modest increase over time in the ability of the partnership to generate a profit. So we're talking about something here that really does not have much growth. Any excess cash that they have, putting it towards oil and gas royalties, I think is a good strategy. But don't expect the distribution of this partnership to surpass your expectations anytime soon. Another thing to think about is while our revenues might be flat here, our revenue per share has come down quite a bit because, of course, we've issued shares along the way. Now, share count has been flat for the last, many years. So there is that. But when we're talking about distribution, they've been able to fund all of these mineral interest acquisitions out of cash. But in theory, when you have the cost of equity at 10.5%, as it is now, there are mineral interests that can be had in the market for, 5 to 10 points of spread above that. So even though they have expensive units, I do believe that there is, some room for them to continue expanding into the future. If we take a look at the balance sheet, we kind of see, again, also a mixed bag. The really bullish momentum of prices really pulled a lot of cash onto their balance sheet in 2022. As you see here, it was pretty typical for them to have, several dozen million, at which point they, ballooned to almost 300 million. And today, still sitting pretty good, 137 million. This is the kicker here. Long-term debt has decreased over the last 10. So they haven't become more indebted. And haven't issued shares in a while. So ultimately, I think that the balance sheet looks very healthy. That being said, I think the way that the price looks right now, again, it's done okay year to date, better than the market at whole. It's really, really appreciated a lot in the last year, and we haven't seen a requisite move in coal prices. In fact, what we're seeing is that over the last year, coal prices have come down quite a bit from kind of this shelf that they were at. Again, these are the Newcastle. I just want to review the most recent report. So our oil and gas royalty volumes were up 9.6% year over year. So the price of the partnership is going to be really, in a lot of ways, riding on the growth of the royalties business. But I think what we need to look at is really objectively, we need to look at that over the last few quarters, particularly in this quarter, our revenue has come down a little bit, and that's just because of weakness in the coal prices. Total revenues in that quarter decreased 3.8% quarter over quarter as a result of reduced coal sales prices, which declined 5.7%, due in part to lower export price realizations. The spot market is going to be more indicative of the export market than it is domestic utility sales, because a lot of those are kind of locked in a year out ahead of time. Net income for the quarter decreased by 81% as a result of lower revenues and higher non-cash accruals relating to certain long-term liabilities and impairment charges, partially offset by an increase in the fair value of our digital assets. They're marking to market the Bitcoin. Adjusted EBITDA for the 2024 quarter decreased 27.7%. Total revenues decreased 4.6% over the 2024 year, primarily due to lower coal sales volume, partially offset by higher other revenues. So the numbers really don't look that good right now. You see here, Illinois Basin. Right now, we've got, in the most recent quarter, we sold the Illinois Basin coal for $54.38 is the spot price right now for this kind of general heat density here. So we had 22% lower year over year adjusted EBITDA in Illinois Basin, and we had 11.9% over the prior quarter at prices that are $10, higher than the spot market right now. Okay. And then in terms of, but you do see here, they actually show expenses to generate that. So that gives you an idea of margins. You see here, expenses are coming up quite a bit. These prices here are more in line on Appalachian, what we see here today. So the coal numbers look pretty bad. Oil and gas royalties also don't look great, for being honest. Prices came down, numbers down across the board. Coal royalties look good. The numbers don't really look great. This is what's important, though. Okay. We have Illinois Basin, so 26 million tons. This annual 34. What we're seeing here is that our total sales tons in 2025, their management is guiding to roughly the same, if not slightly lower, like 5 or 6% lower sales volumes. And then what we're guiding towards here is that Illinois Basin coal will be lower, which right now we see the spot market is even lower than guidance. However, this might still be achievable due to the way that their purchasing contracts work. And then Appalachian, we see our spot market is stable there. We have oil and gas royalties. I'm going to pause the video recording and do some math on these numbers here and convert them, make sense of the guidance, just to get an idea of what our, at least per the guidance, our coverage is. I'll be right back. So what I did here was I pulled the guidance numbers into this Google sheet here. And I'm sure that there's lots of finance bros out there who are willing and eager to tear into my spreadsheet formatting skills here, but I don't care because it works for me. Basically, what I did was just separate out these numbers into low and high end estimates and then backed into the approximate numbers that management is guiding towards in terms of adjusted EBITDA. Now, a few things to note there. The management provided clear guidance on what they think the coal sales prices are. However, for oil and gas royalties, they did not provide guidance. They did not speculate on what the prices of that were going to be. Instead, they just said, here's what the volumes are. So I had to make an assumption over what that came down to. And I assumed $70 a barrel for oil, $4 per thousand cubic feet for natural gas, and then $40 a barrel for NGL. So, unfortunately, I'm not super sophisticated in the tools I have to analyze these markets. It was just a quick and dirty deal. But basically, what I was coming down to was that the coal operations would generate from 550 to 582 million. That our oil and gas royalty EBITDA would be 140 to 150. In fact, that does seem a little high because last year we only did 117 million there. So maybe what we should do, let's just kind of put that a little down. Well, the numbers are still pretty strong. And then coal between 45 and 50. Let's just make sure that these numbers line up. So in 2024, adjusted EBITDA of the coal royalties segment was 44 million. Our numbers are between 45 and 50 million. That seems realistic. Our segment adjusted EBITDA of oil and gas royalties, 117 million. My numbers are 135 and 144. That is probably the wackiest element of the math. And then 548 to 582 from coal. Last year, it was 638 million. Oh, yeah. And this is EBITDA minus CapEx. So all in all, what that does is it shows here, again, free cash flow generation. Well, free cash flow would, of course, be equivalent to this number minus this number. Why don't we actually calculate that? Let's calculate that equals this minus this times. We forgot a zero. So basically what that comes down to, and I might be calculating it slightly different than they are in this particular graph here. But I think it's fair to say that management is guiding towards roughly the same free cash flow generation, and that distributions of 363 million, that does appear to be safe for now, given the strong balance sheet and strong underlying business. So is it a good valuation? I think it's fair to say, I certainly think that in terms of our payout, again, 70 cents per unit per quarter is our distribution to unit holders. Is that safe? I think it's safe as long as this guidance holds, and the market certainly is supportive of that. But how's the valuation? Well, the valuation, I think the best way to look at it is because we're effectively paying out all of the free cash flow in the form of those distributions, and those distributions are 10%, we're at about 10 times cash flow. They're saying earnings, they're saying 5 times cash flow. It's a little different than what I'm calculating, but either way, you see Seeking Alpha is giving it an A grade in terms of the valuation. I tend to agree that it's very attractively valued. Now, is it necessarily undervalued? I don't know if I would argue that, because again, why would something like this be valued at a premium value? But in terms of our yield, I think it's attractive. So as for what some of the risks are, I think it's pretty obvious and goes without saying that your main risk is just the commodity prices. If there is just a dearth of demand for coal, primarily, obviously you're going to see volatility in the unit price for ARLP. Now, again, my belief is that coal prices are going to continue to trend up or at least remain stable, fairly stable over time. Another thing I think worth noting is that it is clear that this partnership has always been very cheaply valued, and that combined with the fact that it has spun off these humongous cash flows has led to, it with about 5 years less of recording time, the partnership has outperformed the S&P by 4 to 1. And of course, the S&P has 10x'd in over the 30 years. So very strong returns. Now, of course, this includes our distributions being reinvested. But I think what I see is that coal royalties, again, I kind of said that this is somewhat of a coal royalty proxy. Coal royalties as an investment have performed phenomenally well. And I think that that's because of a structural undervaluation. But that being said, investors who are looking to deploy capital into something like this should not expect stability, and they should expect volatility both in the unit price and in the cash flows. But if the distribution of this were to be cut even by 10, 20, 30%, we still have a far above 10-year treasury yield of 7, 8%. So again, I think that what you're looking at here is that the best way to look at something like this is to ask yourself, do I think coal will be an energy source in 10 years? And if you think that the answer is yes, then assuming that the yield will at least be maintained, you have your 10% yield, then anything, you know, any sort of inverted yield calculation you can come to in terms of your payback period is the way to look at this. And that makes it a worthwhile investment. Again, when I started accumulating units, it was at 13% yield, making the payback a 7-year time frame. I think that investors looking to invest here should be aware that there is elevated risk because of how much appreciation we've seen in a short time. And the fundamentals of the partnership are not better here than they were here. It just happens to still be attractively valued and still have a good yield. So I think that it is still a worthwhile investment, although there is elevated risk and it's not as good of a deal as it was before. So again, your primary risk is that there is a decent amount of volatility with these shares, but that's bolstered somewhat by the fact that you have this strong yield profile. It's a commodity business subject to commodity prices. So you're correlating your portfolio to coal prices. Whether you want to do that, maybe you think that's a diversification tool like I do, but maybe you don't. And that's something you need to be aware of. In terms of what the chart, and I was looking at this somewhat bearish news here. You see March 18th, one of the SVPs at the company sold 50,000 units, which equated to 1.25 million. After the transaction, he sold more than a third of his units. Okay, so that's not encouraging news. Doesn't mean anything more than what you want it to, but something to note nonetheless. We see here kind of a tale of very interesting chart behavior here. I can't really say with too much certainty that there is much of a pattern here. I mean, I think ultimately what is clear to see is that from the depths of COVID, again, you could have had these units for 1/10 of what they are today in October of 2020. Pretty crazy, right? You see the volatility in these units. COVID was really bad for energy. So just beware that that type of volatility can be underlying in this business. Again, that's your risk. But obviously it's been super bullish since that time. And now it's in a decent uptrend. Now here it kind of got ahead of itself and then pulled back. And then that's what made this area here a good place to accumulate. So Do I think, given that it's kind of in this weird wedge here, do I think that it could kind of trade back into the mid 20s? I do. In fact, it regularly does that. Did that, as recently as a few weeks ago. So I do expect that if we continue to see, as I would expect, the coal markets just kind of flatlined, I don't see many drivers that they go up, many drivers that they go down, because we're in this stagflationary environment where commodities, particularly energy commodities, do well in a stagflation. If you believe that stagflation is here, then something like this should be interesting. If you believe that we are in deflation, in a deflationary environment, well, then you should probably be trading bonds, not master limited partnership units. If you believe that we're in inflation, then I would expect coal prices to rise. I would expect coal prices to be elevated, not necessarily rise from where they are here. And deflation, well, all bets are off and coal prices are coming down, and that'll depress the unit price again. So maybe just consider that by investing in this, you are attaching the portfolio performance of your investments to the coal price. Sadly, I don't really see a discernible chart pattern here aside from more or less it's kind of been up to the right with varying degree. Now, what happened here was that coal prices started to strongly come down, but the market did figure out that there was a lot of stability at the current prices that it's at now. I do expect that regime to continue trading sideways. And as long as I can continue to collect my 280 a share distribution, again, that's more than 10%. I'm happy with that. So I am very cautiously optimistic. Continue here and there when I have some extra cash and we're approaching the upcoming X date. I've got a lot of different MLP units. This is the only one that I've purchased recently. So I continue to like it, although it is volatile and not as well put together as an energy transfer or MPLX. But this is the coal investment I have in my portfolio, and I do see it as a contrarian bet that is a little bit of a diversification tool as well as a yield generation tool for my portfolio. So I like it. And that would be what I would grade it. But I would very much urge investors, if they're evaluating an investment in this, to really be familiar or comfortable with the volatility that energy price fluctuations can generate in the unit price. So, anyways, hopefully you found this useful. I've certainly enjoyed spending time on it. And yeah, let me know what your thoughts are on ARLP. And I'll leave that for your consideration today. But until next time, I'm going to sign off and get started on some writing. So, anyways, I will talk to you soon and have a good rest of your day. Thank